Are you confused about how to track your cryptocurrency cost basis on Gemini? Do you dread tax season because you have no idea how to calculate your gains and losses? You're not alone. The world of crypto taxes can feel like a labyrinth, and one of the most critical parts of navigating it is understanding your cost basis. Think of it this way: cost basis is the foundation of your crypto tax calculation. It's the original value of an asset for tax purposes. Without it, you can't figure out if you've made a profit or taken a loss. It's not just about the price you paid, it includes things like transaction fees and other costs associated with acquiring the asset. Getting this right is crucial, not just for accuracy, but for potentially reducing your tax bill. So, what is cost basis, really? Imagine you buy one Bitcoin for $50,000. Your cost basis for that Bitcoin is $50,000. Now, let's say you sell it a year later for $70,000. Your capital gain is the difference between your sales price, $70,000, and your cost basis, $50,000, which is a $20,000 gain. This $20,000 is what the IRS will want to know about. It seems straightforward when it's just one transaction, but what happens when you make dozens, or even hundreds of trades throughout the year? What if you're buying the same asset at different prices, on different days? That's where things get complicated, and where tracking your cost basis becomes a real challenge. And this is where Gemini comes in. They offer several tools and features to help you with this, but it's up to you to understand them and use them correctly. We're going to break down how to track your cost basis on Gemini, step by step, to make tax time less of a headache. First, let's talk about the different cost basis methods. When you have multiple purchases of the same crypto, you have different lots. When you sell some of that crypto, you have to decide which lot you're selling. The IRS has rules about this, and the method you choose can have a significant impact on your tax liability. The most common methods are first in, first out, or FIFO, last in, first out, or LIFO, and highest in, first out, or HIFO. Let's quickly define each one. FIFO, or first in, first out, is the default for many exchanges and is often what the IRS expects if you don't specify otherwise. This method assumes you sell the first crypto you ever bought. This is a very conservative approach. If the price of your crypto has been steadily increasing, FIFO will likely result in the highest capital gains because you're selling the oldest, cheapest coins first. LIFO, or last in, first out, assumes you sell the most recently purchased crypto first. This can be beneficial in a bull market, as you would be selling the more expensive coins, thus reducing your short-term capital gains. However, be careful with this one. The IRS has specific rules about when and if LIFO can be used for crypto, and it's not a widely accepted method. Always consult with a tax professional before using LIFO. HIFO, or highest in, first out, is a popular strategy for tax loss harvesting. This method assumes you sell the crypto with the highest cost basis first, which can help you minimize your capital gains or even create a capital loss to offset other gains. This is a great tool for savvy investors, but like LIFO, it's a specific identification method and requires meticulous record keeping. The IRS has strict rules on how you can apply this. Now that we know the methods, how do you actually find this information on Gemini? Gemini's Tax Center is your first stop. To get there, you'll want to navigate to the Account section, then Settings, and finally Statements and Taxes. This is the hub for all your tax-related documents and information. Inside the Tax Center, you'll find a section for gain/loss statements. This is where you can download a report that summarizes your taxable events for a given year. But before you do that, you need to tell Gemini which cost basis method you want to use. As of a recent update, Gemini allows you to select your preferred cost basis method from within the Tax Center. This is a huge help, because previously you would have had to do all of this manually or with a third-party tool. Gemini now defaults to FIFO, but you have the option to change it to HIFO or LIFO. This is a critical step, so make sure you choose the method that best fits your financial strategy and tax situation. Again, if you're not sure, talk to a professional. Once you've selected your method, you can download your gain/loss statement. This report is a goldmine of information. It will list all of your sales and other taxable dispositions, along with the date of the sale, the proceeds you received, the cost basis for the asset that was sold, and the resulting gain or loss. It will also classify each gain or loss as either short-term or long-term, which is a key distinction for tax purposes. Short-term gains are from assets held for 1 year or less, and they're taxed at your ordinary income tax rate. Long-term gains are from assets held for more than a year, and they're taxed at a lower, more favorable rate. But what if you've transferred crypto into Gemini from another wallet or exchange? This is a common situation that can throw a wrench into your tax calculations. Gemini has a feature to help you with this, but it requires manual input. In the Tax Center, there's a section for providing acquisition details. This is where you can enter the original cost basis and acquisition date for any crypto you transferred in. It's crucial that you do this accurately, otherwise, Gemini will use the price on the day of the transfer as the cost basis, which could result in an incorrect tax calculation. So, if you bought Bitcoin on another exchange for $20,000 and later transferred it to Gemini and sold it for $50,000, but you don't input the original cost basis, Gemini might calculate your gain as if you bought it on the day of the transfer, leading to an inaccurate and potentially higher tax bill. What about other taxable events? It's not just about selling crypto for fiat. The IRS considers a few different activities as taxable events. For example, trading one crypto for another, like trading Bitcoin for Ethereum, is a taxable event. The IRS views this as a disposition of your Bitcoin and an acquisition of Ethereum, and you have to calculate your gain or loss on the Bitcoin at the time of the trade. Using the Gemini Tax Center and your transaction history, you can track these events and make sure they're reported correctly. Also, earning crypto through Gemini Earn or staking is considered ordinary income, and the fair market value of the crypto at the time it was received is your cost basis. Gemini will provide a Form 1099 MISC for users who earn over $600 in rewards, but you are still responsible for reporting all income, regardless of the amount. While Gemini's tools are incredibly helpful, they can't see the full picture of your entire crypto journey. If you've traded on multiple exchanges, used different wallets, or engaged in decentralized finance, or DeFi, Gemini's tax reports will only reflect what happened on their platform. This is where third-party crypto tax software becomes an essential part of your toolkit. With that said, thanks for watching and until next time.